Oh, the pain. The pain. Oh, the pain. The pain.
Hi guys, it's been a rather traumatic 48 hours for me in the stock market. You may not be aware of this, but most of my stock, at least the largest single proportion of my stock, about say 30% or so, is Telstra. And Telstra took a huge hit on Thursday when they reported the results for the company a little after 9 o'clock. Telstra is a mature telco. They don't have particularly high growth, but the beauty of being a Telstra shareholder is that you got fantastic dividends. And they were some of the best you'd get on the stock market, the ASX. So they were very attractive to investors like me who wanted to see. I've only been in the market for a couple of years, and I wanted to have a solid base, a good dividend earning base of shares in a high cap company. So, you know, Telstra is a big Australian company which provides you with some level of safety, even though it doesn't have particularly high growth. It's paying very good income in the guise of the dividends. The dividends with the recent price drop in Telstra shares has actually been even more attractive, and is with being fully franked, it can almost be like 10%, which is phenomenal income. But of course it's unsustainable, and that's what's happened on Thursday when they reported. I expected there to be a slight reduction in dividends. They couldn't sustain this sort of level of income for the shares. It was just too good to be true. And as in most things in life, when it seems to be too good to be true, it is too good to be true. And this is a classic example of it. So I was primed for a slight cut in dividends. Currently, they were paying 31 cents over the year. I think it was 31.5 last year, so it's been a slight reduction this year. But in the speech that they gave on the prospects for Telstra in the future, they're going to basically have a total rearrangement of the business where they're cutting costs drastically, paying off debt, and are not going to be paying out 100% of the profits to in the form of dividends to shareholders. What they're going to do is cut that percentage back to 70 to 90%, which is quite a hefty cut in returns. However, it still means that you're earning way ahead of bank interest, especially if you're able to take advantage of the fully franked part of the dividend. So it's still quite attractive, but there are better prospects out in the market. Now, for me, it was a bit of a blow. I didn't expect that they would drop the annual dividends from, say, around the 31 cent mark per year down to 22 cents. Now, as you can see, that's almost a third reduction in your income in the near future. It's a bit of a blow, and it did upset me, mainly because it wasn't just the reduction in income, because I've got quite a substantial holding in those shares, as I mentioned. I mean, I'm not a millionaire, I'm not the super wealthy, but I do have a reasonable amount of money tied up in Telstra shares, a fair slab of my capital. As I say, I'd estimate around 30%. Now, I had been planning on actually selling some Telstra shares so that I could actually free up capital to invest in different companies, because the other problem I have now is that the telcos that I have shares in, which is primarily Telstra, with also an additional holdings in TPM, which is TPG Internet, together they make up around 40% of my shareholdings, which is way too high when you're looking at a diversified share portfolio. And it does make you vulnerable, especially in a situation like this, where there's a left field announcement where your dividend is clipped by a third. That's a pretty savage change in the balance of your share portfolio. So I had to wait a very nervous 5 to 10 minutes for the actual price to come up, and boy, it was bad. In my own case, I think I was around $7,000 down at one stage on my Telstra holdings, and that's a massive hit in one day. I've never had a hit of that sort of dimension before. So that was pretty traumatic. You know, the other thing that worried me was that this is just the first day. In a lot of cases, you get bad news. It takes a couple of days for the actual price to actually drop to the lowest level, mainly because it's the amount of about the news getting out to shareholders. It can be delayed by up to around 48 hours as the say brokers get in contact with the shareholders. So you have a second day of selling on top of the first day. So it was bad enough to get that reduction, but I was anticipating that the following day, on Friday, there would be a further reduction in the price. As it turned out, it was a crappy day for the market, mainly because of the terrorist attack in Barcelona. However, the market itself was down around 50 points or so at one stage, but Telstra surprisingly actually had a slight bounce. It actually was green that day, so rather than being 7,000 down, I think it ended up being about 6,500 down at the close on Thursday. It ended up being around 400 or so up, or 400 to 500 up in as far as my holdings is concerned on the Friday. So there was a slight correction there. Telstra share price has been on the slide for some time now, and this has really reached new depths. Of course, the fun's not over yet. Being a shareholder, you also have to endure the pain of the price dropping further when the shares go ex-dividend. If you're not aware what ex-dividend means, it means it's the last date that you can actually purchase the shares and receive the current dividends. And these will be the last of the big dividends that we're going to get from Telstra for some time. And once that date ticks over, then you'll see that people will be dumping the stock and that the price will be even lower. And that's going to be even more traumatic. But you know, it's all on paper basically. I'm not going to be selling my shares at a loss. I did go through that trauma with Woolworths, so that's another reason why I was pretty pissed off about this latest reversal in shares. I had to actually take a capital loss with my Woolworths shares, and I think I lost over $7,000, which basically destroyed any profit I'd make from trades in the previous financial year. So I ended up losing around $98 overall, which is not much. So it showed I did make quite a few trade profits, which is great because I don't just like getting my income from dividends. I'd like to do a mix of strategies. I wouldn't ever be a day trader. It's too traumatic and too stressful, and I just don't think it's worthwhile. And most people lose money day trading. However, there's nothing wrong with basically selling some of your shares for a capital gain and in effect getting yourself a special dividend from those shares, apart from the standard dividends you have by not doing anything, just leaving the shares alone and having them pay you the dividends. So that's basically what's happened. I'm feeling a lot better now because it's been 48 hours and I'm feeling a lot less traumatized than I did initially. But boy, it was a huge shock to the system. And I've only been in the market for 2.5 years now, so I'm a bit of a newbie. And the other problem with the Telstra shares is that they're pretty highly priced, the ones I've got, apart from the latest ones which I bought at this rock bottom price. I'll be wanting to dispose of those ASAP because I'm just trying to reduce my holding in Telstra. I've got far too many of them. But the other problem is that my other shares in Telstra are in the low fives. There's a bunch of them there, and the other ones that are really problematic are a little over $6. Now, they're going to be very hard to dispose of without taking a capital loss because I can't see Telstra's share price going up to $6 in the near future. It may take 2, 3, 4 years. It may happen and then it may not happen. I'll still take the income from the shares, but of course the higher the price the shares are, the lower the percentage that you're getting with your dividends. So they're going to be less lucrative shares, but at least I want to cut down the holdings I have in Telstra so I can then hunt for better shares elsewhere. And I've been looking for higher growth stocks of recent times, and I've been concentrating more on the healthcare sector in the stock market. And I also have favourites like Worley Parsons, which is the oil consultancy company. It's a good trade stock for me. I find that I can generally predict where they're going to go, and I've always made money out of trading Worley Parsons. But you've got to have the patience to wait for them to go down to the right price. In the case of Worley Parsons, to me, the right price is when currently when the shares are down to around the $11 mark or lower. I start buying them up because the oil price will inevitably go up again at some stage, and the last time it went up, it actually went over $12. So that's quite a tidy profit. If you can stay in, you can actually wait until it gets to its highest point. And the protection I have there is twofold. Again, it's a fairly high capitalised company, so it's a big company. And the other good thing about Worley Parsons is it has been the target of a takeover bid by another international company. And so therefore there's a little bit of protection there that keeps the price up. Mind you, anything could go pear-shaped for some reason or other. Worley Parsons, if I bought them at the $11 mark next time, they may plunge for some unknown reason. Things can happen. You know, the proverbial does happen, and after we had that recent stock market slump a year or so ago, Worley Parsons shares slumped to around $4. They were an absolute bargain, but I didn't have money to buy into them. So that was a bit tragic. That would have been a wonderful trade profit I would have got. I could have looked at least 50% or maybe 100% actually on as a trade profit. Now that's a dream type profit, and that's what I'm aiming for right now. I'm aiming for a mix of fairly solid sort of dividend paying stocks, but also chasing some really high earnings on some trades. And I've got certain stocks that have the potential to really jump up big time. And like I say, the TPM telco stocks are much more inclined to jump faster than, say, Telstra, because it is such a mature company. So there is a potential there for me to take a nice juicy trade profit, but time will tell. So that's basically where I am now. It's been really hard going the last 48 hours. It is a scary place, the stock market. It was extremely scary for me on Thursday. Funnily enough, I bumped into my friend, mentor with the stock market, the man who really got me into it. As far as a backstory is concerned, my history of being involved in the stock market is rather checkered prior to this. When I was a kid, my old man gave me $70, I think, and we're talking about back in the 60s, a long time ago, when $70 was worth something. And I bought this mining stock, and it was called Endurance. I mean, how ironic that is. It was a mining stock, and of course, the price just went one direction, and I think they went into administration, and that traumatized me about the stock market for years to come. My father wasn't the sort of person who was a particularly good mentor. He wouldn't really share much information with me on virtually anything. And that's really important to have, I think, to have someone that will actually talk to you about strategies and give you some sort of direction with investing in the stock market. And so for years after that, decades, I just stayed clear of the stock market. I was totally traumatized by it, I admit it. And I would only put my money into property or into the bank. Being very conservative. I mean, as it turned out, the property's been good to me. I've always made a profit buying and selling houses. Not that they were investment properties, but they were for a lifestyle. But still, it doesn't hurt to make money. Every single house I've bought, I've made profit on when I sold it. Well, what forced my hand and got me back into the stock market 2.5 years ago was the declining interest rates on savings. They just got down to a ridiculous level of about around 2% or something. And it just was pathetic returns. I said, look, I got to do better than this. And I knew that my friend had been doing gangbusters over the last decade or so with he had basically some very big Australian blue chips. It was a fairly conservative portfolio, but it wasn't as diversified as the experts would say you should. However, it was incredibly good to him, and he did really well in that period. And much better than most superannuation funds. And and of course much better than what the pundits on in the media would tell you. So that's so that basically forced my hand, and I had to get better returns. I think this is crap. I'm not going to put up with 2% returns on my money. It just isn't good enough. And so I switched to the stock market. Unfortunately, I switched to the stock market when it was in a fairly buoyant time. So that's why, you know, I ended up with, say, Telstra stock that was $6 shares and what have you. You know, it wasn't a good time to buy, but because I hadn't been in the market long enough to really get an idea what the good price was for a share, I naively bought into them, and now I'm regretting it and hoping that someday I'll be able to get dispose of those particular shares. Because I've learnt one thing: you have to be ruthless at chasing cheap shares. You've got to identify cheap shares. You've got to check your charts over a period of years to get an idea where the best value is. I mean, it's only going to be a rough measure, but it gives you something to hang your hat on, and you need that. You really do. And I'll pick some great stocks that have actually gone up in price quite a bit in the last few years. But another lesson that I've learned is you've got to stick with some of these good stocks because they have a potential to go up big time. And I tried trading a couple of them, in particular CSL and Cochlear stocks, and I ended up having them for about $90, which now seems like an absolute bargain. Cochlear is about $160, which is a huge increase on 90, and CSL is about $130, I think, at this stage. Both of them were around $90, and this was only about 18 months to 2 years ago. So that was really dumb getting rid of those. So another lesson I think I've learnt from that is that if you've got quality shares, don't sell them all. Hold on to a portion of them. Trade some of them, but don't dispose of all of them, because if they're quality shares, chances are they're going to have a jump above. If they're in a bit of a trough, they will jump back unless they're abysmally managed. Now, as far as getting a good advice on the stock market, I just want to also give a shout out to Bnadon, who's a young Australian guy. I don't even know which city he's in, but he's got his own site, and he gives extremely good stock market advice, in my opinion. He's got a pretty reasonable portfolio. He's doing pretty well overall. He's got one stock that's driving him crazy, and surprise, surprise, it's related to Telstra. It's actually their retail outlets, but it's run by a different company, and they had a big jump in price, and then they've had a slump since the announcement last Thursday. That's actually hit them pretty hard, so they've had collateral damage from it. But apart from that particular stock, Brandon's portfolio has done extremely well, and he's a pretty smart guy. And you just got to be, you got to have, like I say, you got to have a bit of toughness about you with the market. And you know, even though I've had a kick in the guts, I'll live to fight another day. I've still got the shirt at my back. I'm still making more money in the stock market than I was out of having the money in the bank, and there is that huge potential for quite juicy capital gains. That's my impression of a rather horrific Thursday, and I'm still around, and I'll keep punching and trying to work out new strategies to improve my portfolio.